We've been taught so many wrong beliefs, perceptions, and concepts about money and finance by our parents, by our school teachers, by the media, and by society, and it is keeping you poor. In this video today, I am going to be talking about what those incorrect beliefs, myths around finance are, and those habits that are really holding you back from achieving your goals. And I'm going to be teaching you the opposite way to think, the rich way to think, that different mindset that will actually help you grow your financial security into the future. So let's get going. So habit number one is owning a car. So as I've discussed in previous videos, there is a big difference between good and bad debt. In quick summary, good debt that allows you to scale something, to grow something, to then give you an income. Bad debt is any loans that you undertake to purchase something that doesn't actually achieve you any additional income. In fact, you need to earn additional income to then cover the interest payments. And owning a car fits into this category. Most people buy a car new, and it is quite a poor investment for many reasons. One of those reasons is once you drive a car away from the dealership, it automatically depreciates in value. Secondly, as I've already mentioned, it is actually a poor investment because it's not actually providing you any income. Second reason is people often take out a loan to purchase a new car. This is actually bad debt because a car isn't actually going to provide you any income. As I've already mentioned, it depreciates, so it's actually costing you money. So you've just taken out a loan on something that will depreciate instantly, that is going to cost you money to run and maintain, and then you've also got to pay back the loan. So you need to earn additional income to fund that loan repayments and the interest repayments. Is that a good investment is the question I ask. And I think the other point around owning a car is the opportunity cost of either the capital, if someone's purchased it in cash, or the finance. Because let's take an example, if a car is 30 grand. That means you've either spent 30 grand in cash or taken out a 30 grand loan to buy that car. But what else could you be using that 30 grand for? Well, 30 grand could definitely buy you a property in some parts of the country using a mortgage, of course, and that would actually earn you an income. That would be a use of good debt. And this is the way that's got to be looked at. Using that money to get yourself a return rather than actually the opposite, which is what a car. You can actually use that money to invest, to set up a new business, all of which will give you an income and give you a return over the long term. So point number two, keeping cash in the bank. A lot of people, particularly during recessions, say that cash is king, but that doesn't necessarily mean that you need to keep all of your cash in a liquid current account at all times for those emergencies or rainy days, because all you're doing is actually losing money. Because remember, inflation erodes the value of your cash in the bank. We're in a particularly high inflationary period at the moment. Current numbers are at 6.7% inflation, which means the value of your cash is actually going down by 6.7% a year. And obviously it was a lot more earlier in the year too. So by keeping cash in the bank, you're one, losing money, and two, there's an opportunity cost again to actually keeping it there. So for example, if you put that money in something that's actually going to give you a return, that's a much better use of it rather than keeping it in the bank. So point number three is that having a job will make you rich. This is a big one. We've been taught at all areas of society that we must have a job, and by getting on the career ladder, we will succeed and get the life that we want. And if we play our cards right, if we move to the senior positions in an organization and rise to the top of the ladder, we will become rich. But this is a fallacy, because that will only account for a very, very small percentage of people who may be at CEO level. That is probably less than 1%. So everyone else, the 99%, is essentially caught in a trap, which is their job. And the thing to think about here is that your earning potential through your job and through your career actually has a ceiling. And that ceiling is you and your time. If you wanted a different way of life, for example, if you wanted to work less, that is going to hold you back in your career. If you wanted to, go down to 4 days a week, that's going to reduce your earning potential. But let's look at the alternative to this, which is either investing, having a side hustle, having a business, all of which you can start to leverage. You can start to earn passive income on top of your job. For example, if you invest in property, Amazon dropshipping, being a content creator, having a book out, all of those things would start to earn you money without you having to work more or have two jobs. If you had a business and had a team, the more salespeople you took on, for example, the more your income would grow, and you don't need to clone yourself. And it's the same with buying property. The more properties you bought, the more your income would grow. But you're unable to do that for yourself. You're not able to replicate yourself and have three of you out there earning a wage. And this is the big fallacy of having a job and the fact that it will make you rich. It is not true. The thing that will make you rich is having multiple streams of income, paying yourself first in terms of investing, using your money wisely to then start to earn a passive income, which will then be able to compound over time to give you that real wealth. So point 4 is that having a savings account is actually the same as investing. The savings accounts that are often used are actually fairly low in terms of interest rates, even where we have had interest rate rises for 14 months now. The highest interest accounts out there are between 5 and 6%. But inflation, as I've already mentioned, is at 6.7%. So actually putting money in these savings accounts is only breaking even, potentially even losing you money. So that's the first thing to sort of state, that even putting your money in these savings accounts isn't actually giving you a return. It's just kind of minimizing your losses. And what I would also say is that often these savings accounts are like easy access. So people just kind of use them as a bit of an emergency fund. They will dip into them regularly. So, you know, they've gone into the overdraft that month. I'll just dip into my savings to cover that holiday. Oh, to buy that new jacket. Oh, I've got someone's birthday coming up. I'll just take some savings out of that pot. Savings is very much for the short term, for emergencies. And there's nothing wrong with that, having some money that's liquid that you're able to get at in an emergency in those difficult times. But it's about ensuring that that's a minimal amount, because as I've already mentioned, all that money in there is actually being eroded by inflation. Now, putting money aside regularly and paying yourself first and putting money into some kind of investment, whether that's an index fund, whether that's a property, saving up for a property deposit, something like that, is very, very different to a short-term savings account that can be dipped into. An investment and an investing account is all about the long term, and it is locked away and shouldn't be touched, shouldn't be looked at really, because if you keep looking at it, you'll be tempted to do something. And that's what they say, you know, people that have stock accounts or index funds, when the market drops, they're tempted to panic and pull money out. And actually that's the wrong thing, because we know that the market will always recover, whether it's property, whether it's the stock market, it will always recover. The fluctuations are normal, and therefore we shouldn't be panicking when those falls happen. And actually we should just be leaving our investments be for 20 plus years, because that's what they're meant to be for. So in summary, investment accounts are there for the long term, for compounding growth, and just to be left alone and to sit there. A savings account is something that's there for emergencies, but we are taught that actually it's there to grow our wealth and we're actually making some good returns on it. But as we know, because of inflation, it's in fact the opposite. So point number 5 is that owning your own home is an asset. As I already mentioned earlier, there is a difference between good debt and bad debt. In his fantastic book, Robert Kiyosaki in Rich Dad Poor Dad states that anything that doesn't earn you an income that you invest in is actually a liability because it's costing you money, and anything that you invest in which actually earns you money is a real asset. So owning your own home needs to be seen through that frame of reference that is actually a liability which is costing you money and is actually an example of bad debt. So why does your own home cost you money? Well, it firstly costs you money to buy it in the first place. You've obviously got ongoing maintenance costs, interest payments, and other bills which you need to find the funds to pay and cover all of those expenses. And although you'll get some capital growth, statistics actually show that people who own their own home only stay in it on average for around 9 years. So that's only 9 years of capital growth. So they might actually miss out on the bigger wins, which, as we know, in property happen over the long term. And therefore, the gains that they're actually making in that capital growth can sometimes be undone by all of the costs associated with the property upkeep and as well as the cost of moving. Ramit Sethi, finance guru, in his book, I Will Teach You to Be Rich, actually states that the cost of moving is around 8 to 10% of the purchase price. These costs include the legal fees, stamp duty to purchase the onward house, finance fees, moving costs, of course, potential refurb to get your house to the point of selling, and agent fees to sell the property as well. So that's quite a hefty amount of money. And he actually advises that he doesn't think it's a good idea from a financial perspective to actually buy your own home unless you plan to live in it for 10 years. If you don't stay in it for over 10 years, it's not actually going to be worth owning a property, and it's likely that even the gains you're going to make from capital growth in that time are actually going to be undone by those costs anyway. And if you invested that £200,000 in investing in property, for example, you get the benefits of owning a property, having a passive income, and gaining in terms of capital appreciation in the long term. So that is why I believe that actually it's better to invest in property rather than owning your own home. So point number 6 is a huge one. It is such a pervasive belief in society, and it is all around the fact that you should pay off your own mortgage, whether that's on your residential home or if that's on a property that you invest in. So as I've already talked about the difference between good and bad debt, and I already talked about how actually owning your own home is kind of bad debt because it is actually costing you money and not giving you a return. So looking at it through that lens, by actually paying off your mortgage, all you're doing is feeding into that bad debt. And all you're essentially doing by paying off your mortgage is giving the bank more money. You're not earning additional return on that money. You're just giving them more money for them to earn a return on. And the other thing you're doing is reducing your ability to actually use that capital elsewhere. So by paying off your mortgage, you're reducing your capital available to potentially go out and buy property or to invest elsewhere that will actually give you a return. The thing is to emphasize is that by paying off your mortgage, you're not getting anything in return for that. You're not growing your income. You're not growing your wealth through that. It's not an investment. The bank isn't actually giving you a guaranteed return on that money like you might get elsewhere. All you're doing is having a shitload of equity sitting in that property. And if you stay in that property for 10, 20 years, that's 10, 20 years of that capital just sitting in that property. The bank's earning a return and you've had 20 years of not using that capital elsewhere. And think of the returns that you could have got and the compounding returns that you could have got using that capital elsewhere. And yes, even if you sold that house, you would still get the equity, but that's only if you sold it at the right time and at the right price. Because obviously if you sold it in a crash, for example, then there is a chance that you would have lost some of that equity that you built up. So by paying off your own mortgage, there isn't actually a guarantee that you're going to be any better off, that you're actually going to make a return. And there's a huge opportunity cost by putting that money into that property rather than investing it elsewhere, buying an investment property, for example, which you know, if you hold on to it for the long term, will actually bring you good returns. So this one is such a dangerous, commonly held belief that is really holding many, many people in society back. So I've given you 6 beliefs, and there is more that are holding you back, because financial education and financial literacy is really poor in this country, and we are actually taught completely the wrong advice across the board right from a young age. And there's also the danger of herd mentality, because if you see everyone else doing it, it's normal that people follow the crowd, and then it just exacerbates and snowballs, and then everyone's caught in the trap of all of the 6 beliefs that I've mentioned today. And this herd mentality and this wrong advice and wrong education means that many people are trapped, and it's a real shame because there are so many different ways of thinking about money and doing lots of different things, lots of better things with your money. A lot of people just don't know about this stuff, even in the middle classes, and that's what's holding them back, and that's what's keeping them poor. But remember, there is a different way and there is a different mindset, some of which I've gone into today. So you have the ability to change your mindsets and your habits in order to give yourself a better future. If you're enjoying this video today, please do subscribe to our channel. I'd really, really appreciate your support. It really does mean a lot to us and makes a big impact. So thanks a lot.